Greetings. Today is Friday, April 26th, 2024. This past week, I had the honor of being asked to write the Chart Advisor newsletter for Investopedia to represent the CMT Association. And in one of the newsletters, I think it was Thursday's edition, I talked a little bit about presidential elections and how the stock market reacts to that. And I thought you might enjoy some of that data. Also want to talk briefly about yesterday's GDP report, and then what I would argue is the market's overreaction. And then we'll wrap up for the day, taking a look at the new release of a book written by a friend of mine. So that said, on the screen right now, we have a bar chart representing the S&P 500 for every year since 1976. I started this analysis in 1976 simply because that's the year that I was born. The problem that I have with this bar chart is you can't really see how the year transpired. You just see the end result. So let's switch this to a line chart. Same data is now on the screen, but now you can see how each year kind of transpired. The bold red line is the current year, 2024. Now, in particular, what we want to do is we want to do the math. And if you take the returns, which are on the far right side of the screen, if you take the returns, you do the math, you'll find that the average return for the S&P 500 during a presidential election year since 1976 is approximately 6.9%. However, 2000 and 2008, those presidential election years were recessionary years, intensely negative years. So let's remove those 2 years because we kind of don't think that's likely to happen this year. So if you remove those really bad years, you get a return on average of approximately 13.25. However, statistically, if you remove the 2 worst years, you should probably remove the 2 best years. If you do that, you find an average return for the S&P 500 since 1976 during a presidential election year of approximately 10.3%. However, what I'm particularly interested in, since April is almost over and since the election is early November, I want to see what does it look like from May through October. That data is now on the screen. Again, those years 1976 through to the last presidential election year 2020. Again, May through October. Doing the same exercise, you find that the average return is about 1.5%, but if you remove the 2 best and the 2 worst years, you get an average return for the presidential election years since 1976 of approximately 2.7%. However, the reality is that's only 8 years. If you remove the 2 best and the 2 worst years, you're only doing data on or doing an analysis on 8 years. That's not a very good sample size. So let's expand the data to the extent that we can. So now we have the data for the S&P 500 every presidential election year since 1956, because I believe that is the first presidential election year since the S&P 500 was created. Again, removing the 2 best and the 2 worst years, you do the math, you find that from May 1st through October 31st during a presidential election year, the S&P 500 is up approximately 2.8%. So I say this, I went through this exercise just because what we typically see during a presidential election year is a bit of a muted market as the election draws closer and closer. April was obviously a very tough month. We'll go into detail on that in our monthly market monologue, which I will shoot for you next week. But what do we expect? Well, we shouldn't probably expect much. But the point here is also, this is why we are more active in our approach, or far more active in our approach, because just because the broad market is perhaps going to give us some muted returns, perhaps, between now and the end of October, that doesn't mean every sector or even every country. There are some interesting countries that are setting up and actually breaking out that we are want to be particularly mindful of. So that is one of the reasons why we are very active in our asset allocation and our management approach, is because just because that's what we expect on average, we're not looking to be average. Having said that, let's take a look at the latest data for GDP. Yesterday, the Bureau of Economic Analysis released their advanced estimate on first quarter 2024 GDP, and that math suggests that the economy expanded by about 1.6%. Now, some have criticized that stat and say that it's a far cry from what we were experiencing in the third quarter of last year. And while mathematically that's true, let's also try to remember what the Federal Reserve is trying to accomplish. They're trying to accomplish a slowing down. They're trying to get the economy to slow down so that inflation can get a little bit better under control. Remember, in the last several videos, and I'll probably talk about it in next week's video as well, inflation has ticked back higher. So the Federal Reserve is trying to get the economy to slow down without causing a recession. So far, the GDP stats suggest that they are doing a relatively good job. I'm not saying they're perfect. That's not what I'm saying. But so far, the economy is indeed slowing down. It remains to be seen if they will cause a recession. But so far, this is actually relatively good news for several different reasons. But now let's take a look at how the market reacted to this news. On the screen right now is the 5-minute candle chart for the SPY ETF, which mirrors the S&P 500. The blue-gray box, that is the actual market hours. Everything before and after that box represents either pre-market trading or after-market hour trading. So what I want to talk a little bit about is how the market reacted. Guess when that GDP report was released? It was released right here. And you can see as soon as it released, we started to see some pressure in the S&P 500. But as soon as the market opened, it was only about 30 minutes after the market opened that the S&P 500 started to rally. Now, again, my friends in the news media, they'll probably report to you that yesterday the S&P 500 was down about 0.4%. But again, this is why we like to look at the charts ourselves. This is now a daily chart. And was the S&P 500 down? Yes, that's Wednesday and that's Thursday. So yes, technically the S&P 500 was down 0.4%. But look at how the day's trading worked out. From the open to the close, the S&P 500 was up 0.8%. From the low of the day to the close of the day, the S&P 500 was up 1.2%. So yesterday's stock market action was actually a lot stronger than the negative 0.4% that you might have heard about. So I won't go into a ton of detail here, but one of the big questions that's on everybody's minds is whether or not the Federal Reserve is going to cut rates. But on the screen right now, we have two different data series. The green line represents the Fed funds rate, and the blue line represents the 10-year Treasury yield. And what I'm trying to show, the data is going back all the way to the 70s. What I'm trying to show is that the 10-year yield does a pretty good job of being a proxy for the Fed funds rate. If we zoom into that, you can see the yield for a 10-year Treasury has started to rise. And so earlier this year, we talked a little bit about the fact that if the Federal Reserve is going to cut rates, 4.25%, 4.5% might be a reasonable target. Well, why did I say that? Because that's what the that's what the 10-year Treasury yield was suggesting at the time. Well, those rates have risen to up to about 4.65%. So if we're going to get any cuts this year, which is debatable, and we can talk about that later, 4.6 is perhaps where we might end up if they cut at all. But I want to wrap up by highlighting a book written by a friend of mine, Anthony Lee. If you go to Amazon, search Anthony Lee, Race for Greatness, you'll find his book. You can see that I've already bought a copy. I'm looking forward to reading it. Anthony is a friend, and he's had a wonderful career and a great story. So if you're looking for a good summer read, I encourage you to check out Anthony's book. That said, that'll do it for today. I would say in general, our asset management process is designed to minimize drawdowns while capturing upside momentum. If you are in the need for a professional portfolio management, by all means, feel free to reach out to us. You have our contact information on the screen. We serve individuals and families in reality all across the country. So until next week when we do our monthly market monologue, thanks for watching, and we'll talk to you soon.